All right, well, this is course video 24. We're in chapter 16 of your textbook Poogle, and we're going to talk about the meaning of the current account. And from your reading, you now know that the current account is a record of transactions in goods, services, unilateral transfers or gifts, and then income flows like dividends between residents of one country and residents of other countries. And for the purposes of this video, and usually theoretically, we focus on trade in goods and services because that's by far the biggest category within the current account, and it is the one that is most likely to cause trouble, at least for the US. So the current account then for us is equal to the difference between the value of exports, X stands for exports, and imports. Okay, and so what that means is if we're a country like the US, so let's look at some of the deficit countries, what that means for them. The US is a deficit country, but it's rather an unusual one, so we'll look at some other countries as well. A deficit country is a country where the value of exports is less than the value of imports. Well, how can that be? How can we end up importing things that are more valuable than we export? The obvious answer is that somebody must be financing our transactions, and this comes in the form of capital inflow. So if we go to the financial account in a deficit country, there is a surplus on the financial account. Sometimes the national monetary authorities get involved too, which I'll talk about in a minute. But assuming the national monetary authorities are not involved, we have a financial account surplus, also known as net capital inflows. So to be very casual about it, let's say the US exports, some deficit country exports $10 billion worth of goods and imports $12 billion worth of goods, then they have a deficit on the balance of trade, which is also, this should be the deficit on the current account, deficit on the current account equal to $2 billion. But what's going to happen? Well, one possibility is that foreigners decide to take the $2 billion extra that they earned on selling goods to the United States, that they have left over after they've bought the goods they want from the United States, and they can buy US financial assets. So this is where you get the surplus. So for example, we import more goods and services than we export, but we export more shares in companies or more US government bonds to be held by foreigners. So the current account deficit is associated with a financial account surplus and net capital inflows. And then the question is, well, if we're someone like the US, we've been doing this for years, can it continue? And the first thing to say is, as far as we know, it probably can, because one of the things that is true about the US is it's a very large country with a great deal of financial stability, and foreigners really like holding US assets. There's a fairly strong preference for US assets, both among US citizens and also among foreigners. So sometimes the financial account is actually the cause of the problem. For example, you could have a situation where everyone wants to buy American real estate or invest in the US stock market, or times are tough, people are afraid, and the US government debt is seen as the safest asset in the world. Everyone wants to buy the US government bonds, and so capital flows in, pushes up the value of the US dollar, and creates the deficit on the current account. So just because we always talk about the current account first doesn't mean that everything originates in the current account. It could actually be a very strong preference for buying US financial assets that ends up causing the problem in the current account. So for the US, I would say it probably can. If we think about, say, Mexico in 1995 with the peso crisis, this is a good example of a country that doesn't have the type of leverage that the US has. So what happened was people were uncomfortable with the deficits in Mexico. They were, and they just started to pull money out, and you had a big capital flight from Mexico. So you had, you had a current account deficit that was financed, and then suddenly all the flows reversed. So you have a reversal of a sudden, rather catastrophic reversal of capital flows going from into Mexico and then out of Mexico, of capital flows, sometimes called capital flight, and that caused very great damage to the Mexican economy. So it's something of a privilege for the US to be able to sustain these very very relatively large current account deficits over relatively long periods of time, and it reflects the strength of the US financial system. And then you have a country like Greece, which also got into similar problems, and Greece is rather hampered. I mean, Mexico responded by losing a lot of financial capital, and the peso fell. Greece is locked into the euro area, and so it doesn't have the ability to adjust in the same way that Mexico could. So it's sort of twisting in the wind, really. That's the problem of being in a currency mechanism. If you're a country that is prone essentially to current account deficits, so locked into the euro area, and then they sort of essentially partial default on the debt, where sort of the polite way of saying it is that investors in Greece took a haircut, and a haircut means that an investor gets pennies back on the dollar from a particular investment. So people got sort of, I guess they got kind of stiffed out of some of the money in Greece, but they didn't have the ability to devalue essentially against a strong country like Germany because they were locked into a fixed exchange rate mechanism via the euro area. So US has a lot of privilege as a deficit country. It has current account deficits that seem to be easily financed by an appetite for US assets. Other countries are not so lucky, and they can face sudden reversals of fortune like Mexico did in the 90s. Greece continues to have a lot of problems. A surplus country, of course, I'll just name one, for example, like how about Germany or something. Surplus country like Germany, they have a situation where on the current account, the value of exports is greater than the value exports is greater than imports, so they have surpluses, so they are capital exporters. So they have a deficit on the current account. They have a deficit on the capital account that offsets the surplus on the current account. So they have a surplus on the current account, and the capital exporters, they have a financial account deficit, meaning that they have capital outflows. And in the next video, we will continue this discussion. We'll talk about the role of monetary authorities and also what role domestic savings plays in leading to these imbalances.